Welcome, everyone. I'm Susan Murray. I'm one of the partners at Trust Associates, and on behalf of my colleagues and, of course, the team at Edison, I'm delighted to welcome you to our first webinar of 2022. We're delighted to have four speakers joining us today. Firstly, Ewan Lovett-Turner. Now, Ewan will be well known to many of you. He has over 15 years' experience in the sector, covering a wide range of equity and alternative investment companies. And Ewan heads up the well-regarded investment companies research team at Numis, and he's going to set the scene for us today from a broking perspective. Our second speaker today is Elisabeth Scott. Elisabeth has been chair of the AIC since January 2021. Elisabeth's an experienced non-exec director and is currently chair at India Capital Growth and a non-exec at Allianz Technology Trust. Today, Elisabeth's going to be wearing her AIC hat, and we look forward to her contribution. Our third speaker today is going to be Andrew Summers. Andrew is head of fund research at Investec. Now, he also will be well known to many of you. He heads up the team that covers collectives research, and today we'll focus on the investor perspective. And last but absolutely not least, Moira O'Neill is going to be our fourth speaker. Moira started her career as a journalist with roles including deputy editor at Money Observer, personal finance editor at Investors Chronicle, and editor at Money Wise. Moira joined Interactive Investor in 2018 as head of personal finance and will share her insights on the retail investor. Now, before we start, just a couple of housekeeping points. We've given each of our speakers the challenge of speaking for around 5 minutes, keeping plenty of time for questions at the end of the presentations. And we're going to be aiming for a finish time of around 11:45. Now, if you'd like to ask questions, and please do, please use the Q&A tab at the bottom of the screen, and we'll do our very best just to cover as many as we possibly can in the time that we have. It seemed appropriate at the start of a new year to take this opportunity to look back at some of the key trends for investment companies in 2021, as well as asking each of our speakers to focus on themes that would be important in 2022. So without further ado, I'm going to hand across to our first speaker, Ewan, who will set the scene from a broking perspective.
Thank you very much, Susan. And I'll try and do a bit of a whistle-stop tour of some of the industry trends, issuance trends, and what we're seeing in investor demand. These are the general subjects I'll go over. I just have published a sort of 50-odd page note that goes into everything about that. So please get in touch if you want a bit more detail on that. But I'll kick straight off on the next slide, actually, and show you that record year for issuance, around 6.2 billion raised, compares to the previous record of 14.2 in 2006, and nearly double the 8.4 raised in 2020. So really an excellent year for issuance. I suppose every good cynic would say, after a record year, are we in some sort of bubble? But I would highlight the just dramatically different nature of issuance that we're seeing compared to 2006, 7 and 8, when there were over 200 IPOs during that period. Over 80% of issuance was in IPOs. Whilst last year there was just 15 IPOs, a decent number, but nothing in that sort of bubble territory. And if you slip onto the next slide, you'll actually see the nature of that issuance very, very different, and it's dominated by secondary issuance by existing funds, 74% or so of issuance on those funds. So if you're delivering on expectations, either on return or in some cases deployment for recent IPOs, then you can go back to the market and raise additional capital, rather than perhaps being focused on more speculative new issues or unproven strategies. This is also reflecting investors backing what they already own and looking for scale and liquidity. And here we have what an IPO actually looks like, and perhaps tackling the perception versus reality. And on the left-hand side, you see that over 70% of IPOs since 2015 have been 150 million or less. And really, with many investors looking for 2, 3, 4, 500 pound new IPOs to get the scale that they want. Quite a disconnect between that expectation and reality. The average size around 135 million. And so, a little bit of expectations need to be set. But interestingly, this last year, significantly larger IPOs, 243 million, slightly inflated by the billion raised by Peters Hill, but that drops still to over 200, around 200 million, if you exclude that, the likes of Cordiant, Digital 9, Victory Hill, all addressing large markets and raising substantial amounts of capital. So interesting to see if that continues and whether that can open up a new investor base for the IPO market. The next slide, you see the nature of the issuance that we've seen, alternatives dominating as it has in recent years, around 75%. And I'll show you a little bit more on the sectors on the next slide. But on the right-hand side of this one, we're showing that actually not all about yield. Some of the lower yielding strategies have also been raising money, and some of the recent issues a bit more of a growth story alongside income and yield. So the next slide, you'll see that summed up. Clearly, infrastructure, the stable nature of that return profile, renewables, the ESG angle, and clearly power prices have been positive in that area, and especially property, all speaking to that alternative income demand that really remains there. But also money raised in private equity, particularly the Schiehallion, Chrysalis, HG Capital. So investors looking a bit more towards growth, and probably on the far right you see is the likes of music royalties and shipping. But specialist debt a little bit out of favour. On the equity side of things, there still are options to raise capital and the ability to raise capital to funds with differentiated mandates and strong retail presence. You see a number of growth funds raised money earlier in the year, and then Smithson been very consistent. Mortgage, Scottish Mortgage at the end of the year, and then some defensives in the likes of personal assets, capital gearing, rough are all raising capital. So the next slide, you'll see that growth in alternatives, and interesting to see the government now trying to jump on that bandwagon with LTAFs. So long-term asset funds, open-ended funds looking to invest in less liquid asset classes. You sort of seen it here first with the investment companies world. Be interesting to see if those vehicles, how they do launch. I'm sure there will be over time, but some hurdles in terms of getting trustees to back new vehicles, and also to the logistics of platform investing on those. But perhaps more suited to quasi-liquids, which still leaves a space for the investment companies world. And really just summing up what that's sort of shown, the next slide, you can see the investment companies world has actually been growing at a faster rate than open-ended funds, around 15% over the last few years versus 10, 11 for open-ended funds. But clearly the right-hand side chart showing there off a much, much lower base. I won't really touch much on M&A and consolidation, but just there has been a lot of it going on. More scope for M&A given that move to alternatives. Subjective valuations means more scope for more aggressive M&A, and tidying up of the shops of things like Invesco, Aberdeen, and Brevin Howard. So some smaller funds disappearing. The next slide, you'll just see where they're 50-50 odd alternatives and equity funds around 250 billion market cap. And the sum up slide, I won't really go through much of that, but maybe something for you to take away. A few of the risks on the right hand side, such as fees and liquidity, but the left hand side, a lot of good things going on. ESG, I'll leave to Andrew, but in general, I think a record year for issuance, the investment companies sector in a good place, satisfying that demand for alternatives. We'll ask some questions about how they cope in higher interest rate environments. But generally, I think it has been a bit of a home for innovation in the likes of renewables, exposure to private assets, and is well placed to continue that growth going forward.
Very helpful indeed, particularly as a scene setter. Elisabeth, can I pass across to you, please?
thank you to you and for your excellent roundup of industry developments in 2021. And I just wanted to show you this chart, which I think sort of summarises a lot of what Ewan's just said, and is the chart that Richard Stone, the CEO of the AIC, uses regularly in presentations to the board and to others. And just to say that you can see on the left-hand side the size of the industry at the beginning of 2021, and then you can see about £5 billion leaving the sector in share repurchases and tender offers, another £4 billion paid out in dividends to shareholders, a total of about £18 billion in IPOs and secondary issuance, and then £4 billion worth of gearing increases, which I think is interesting, and finally. And of course, by far the largest part, £34 billion of the increase in the market cap of investment companies due to market movements. And as Ewan pointed out, and we're still on the original slide, as Ewan pointed out, alongside the successful IPOs that the industry has seen, there have been mergers, 5 completed and 6 underway, changes of management group, 5 completed in 2021 and another 2 in process, and quite a large number of fee reductions. I think at the last count, the AIC had found 31 instances of fee reductions. So all that points to the fact that the boards of investment companies have been working very hard over the last year to try to get better value for shareholders. Just going on to the next chart, which shows 2 pie charts. The one on the right-hand side is December 2011, and the one on the left-hand side is December 2021. And that just shows the mix of, or the sectoral mix of the industry. And I think the big points to take from this are that the equity, straightforward equity investment companies have declined as a percentage of the whole, quite considerably, and the slack, if you like, has been taken up by infrastructure and the flexible sectors, the multi-asset sectors, which have both grown or frankly been introduced over that period of time. And of course, the investment trust structure is perfectly suited for those sorts of investments. So now looking forward to 2022, what do I think we're all going to be thinking about as boards? The first thing is going to be inflation. I mean, clearly, we've been reading about it pretty much all the time over the last few weeks and months, and it is definitely going to be part of the discussions that boards are going to be having with their investment manager and with their shareholders. And many shareholders will be concerned about dividend payments. Are they going to be able to grow in line with inflation? And of course, this comes after a pretty tricky period for corporate dividends, when many companies were forced to cut dividends at the beginning of the pandemic. So from that perspective, I'm sure that many boards will be looking at using revenue reserves to encourage, to allow dividends to increase in pace with inflation, at a pace with inflation, for example. But there are also other themes that investors in investment companies can look at. And of course, there are many different types of investment companies, those that are investing in real assets, in infrastructure and commodities, all of which play well to an inflation theme. And of course, if inflation lasts longer than expected, I think that boards are going to have to be absolutely eagle-eyed in their assessment of performance and how that performance is generated by their manager. Is your manager sticking to their style? Are there changes, and should you be concerned about them? And I think this is going to be a really important job for boards in the coming year. ESG, I know Andrew's going to talk about that later on, but I know it's been on everybody's board agenda over the last 2 or 3 years. And the AIC has submitted its response to the FCA consultation on the Sustainability Disclosure Requirements, or SDR. And we understand that investment companies will have differing views on ESG objectives and strategies, and that each of those is a matter for each board to agree with its shareholders and its manager. And we've also taken the view that investment companies should be in scope. And we have suggested that the hurdles for sustainability claims should be demanding in order to avoid the greenwashing claims that funds are so often confronted with. And we think that quite a tough regime on ESG disclosure will benefit investment companies with established boards able to hold managers to account as regards their ESG claims. And finally, shareholder engagement. And this is obviously going to continue to be an integral part of the role of boards. And from an AIC perspective, we're delighted that all of the investment platforms participated in our Shareholder Engagement Award, which we introduced last year. And the award was won by Interactive Investor, and you'll shortly be hearing from Moira, who will, I'm sure, be talking about some of the initiatives that they've introduced to make it easier for shareholders to vote. But whatever the nature of your shareholder register, for boards, it's obviously far easier to communicate with institutional investors than it is to communicate with the self-directed investor. And it's even more difficult to persuade the self-directed investors to vote, particularly if the vote isn't an existential one. And some of you may have been here last year, or in late 2020, when I spoke about my experience of the India Capital Growth Fund continuation vote and the work that the board, the manager, the broker, the PR agency, and all sorts of other people did to get the vote passed and to introduce a redemption facility. And that redemption facility closed on the 31st of December 2021. And I'm pleased to say that redemptions were less than 15% of the total share capital. And I really do believe that the efforts that everybody made to engage with individual shareholders were really important in the successful outcome. And finally, the AIC, the pressure for diversity on boards isn't going away. And if you aren't presently a director of an investment company, but you're interested in becoming one, or if you know someone from a diverse background who would make a really good investment director, please do direct them to the AIC pathway. It provides an excellent range of resources for aspiring directors and is a great starting point for a new career. And with that, many thanks to you all for listening. I'll hand you back to Susan.
And I'm going to pass over to Andrew now.
Good morning, everybody. Thank you very much. Thank you for your attention this morning. Elisabeth and Ewan have already made a lot of great points and given all of us, and including me, plenty to think about. I would like to focus my remarks on the area of ESG and stewardship, and to do so using 3 pillars, and it is the third pillar that I would like to emphasize this morning. So just imagine 3 ESG and stewardship pillars. The first pillar is the way that investment managers who you oversee as NEDs integrate ESG and stewardship into their investment decision making. So to the extent that investment managers are buying assets or engaging with management or issuers, your role as an NED in ensuring this is robust is key, and I'm quite sure is very well understood by you all. The second pillar is the way that the investment company on whose board you sit integrates ESG and stewardship into its operations. And for externally managed investment companies, this will be largely how the board oversees ESG integration and stewardship activities of the investment manager. The third pillar, which I want to focus on today, is the way that shareholders of investment companies must integrate ESG and stewardship into their investment decision making. And crucially, the role that investment managers and boards of investment companies have to understand and facilitate that crucial function. And the best way for me to illustrate that is via looking at 2 specific examples: the UN Principles for Responsible Investing and the UK Stewardship Code. So let's take the UNPRI first. I believe that the UNPRI will become the gold standard for ESG due diligence for investors. We are signatories, as are all of our major competitors, as are companies such as Hargreaves Lansdown. And using the 3 pillars framework that I have mentioned to you, earlier, many investment companies themselves represented here today will also be UN signatories, UNPRI signatories. The investment managers will be UNPRI signatories. But the third pillar is that the shareholders of your investment companies are increasingly likely to be UNPRI signatories. And what does that mean for investment managers and boards of investment companies over and above what they may already be doing as signatories themselves? And to get an insight into that, I would encourage you all to look at the reporting modules that are relevant to us as investment company shareholders. These will be, firstly, the module that helps fund selectors demonstrate how we incorporate responsible investment factors into how we select, assess, and monitor third-party fund managers. Secondly, shareholders' investment companies may also look to the listed equity module of the UNPRI, insofar as they will be investing in the equity of investment companies. And of course, us shareholders will be looking at the asset class specific modules of the UNPRI as well, depending on the asset class of the investment company. And when you look at these modules, it'll be clear that they reveal a very heavy emphasis on the need to demonstrate rigorous and demonstrable integration of ESG considerations, specifically to quantitatively measure ESG risks and opportunities into asset valuation models, and thus investment decision making. And this is a key point. So from the first pillar perspective, the role of the investment manager, we need to see increasing evidence of investment managers quantifying ESG considerations into the ways that proportionately impact asset valuations. And from the second pillar perspective, the role of the investment company, how is the board overseeing this? But crucially, from the third pillar perspective, the role of the shareholder, how do we quantitatively measure ESG risks and opportunities into the valuations of an investment company? So put simply, as UNPRI signatories, using ESG considerations, how do we adjust our share price targets for the investment companies that are represented here today? And how can boards help us with that? Appreciating the risks of not doing so. Now let's look at stewardship. The UNPRI asks us, amongst other things, to assess whether third-party investment managers take an active role in their participation in collaborative stewardship initiatives. Can your investment managers demonstrate just how active they are in their participation in collaborative stewardship initiatives? We are also asked, as part of our UNPRI submission, whether our investment managers' voting track records demonstrate the prioritization of systemic issues. These are two crucial points in these examples. Firstly, if we are being asked these questions as part of our UNPRI submission, we will be looking to the investment companies in which we invest to help us answer them. But secondly, we need to demonstrate these attributes ourselves. So it isn't enough for our investment managers to take an active role in collaborative stewardship initiatives. We have to do it as well. So what does that mean for investment company shareholders' actions and priorities? So this brings me on to the stewardship code. And again, there is a strong emphasis on measuring the impact of stewardship and the collaboration between investors. And in both instances, these will represent new challenges for many investors in investment companies. Let me just give you two examples. Principle 7 of the Stewardship Code says that signatories should explain how information gathered through stewardship has informed the acquisition, monitoring, and exit decision-making. So as an investment company shareholder, we have to demonstrate how we use our stewardship of investment companies to inform our acquisition, monitoring, and exit decisions of those investment company investments. And stewardship principle number 10 says that signatories should, where appropriate, participate in collaborative engagement to influence issues. Now, given most investment company shareholders are unlikely to be able to influence events on their own, much more collaboration will be required. And we have signed up to new bodies such as the Investor Forum and the UNPRI collaboration platform, and we are looking into becoming members of the Institutional Investors Group on climate change. And remember, the emphasis increasingly is on being able to show a demonstrable positive impact of our stewardship and collaboration. So what is clear from the UNPRI and from indeed the Stewardship Code is that divestment is increasingly being seen as a last resort. And in its place will be much more active engagement and active stewardship by shareholders. And the good news is that investment company shareholders may become more long-term. And this is helpful in a sector where liquidity is often a challenge. But it comes at the cost of much more engagement and collaboration. And are investment managers and investment companies and boards ready for this shift? So to summarize, investment company shareholders are now signing up to many of the same bodies and standards that your investment managers have long signed up to. And this creates a new challenge for investment managers, for boards, and for shareholders. And so my question to you today is, how do you as NEDs create the conditions whereby your shareholders, such as us, can demonstrate that our engagement with you and our collaboration with your other shareholders have positively influenced the investment company? And this conversation by itself is, of course, a step on that very journey. Thanks.
Excellent. And I'm going to pass across to our last speaker, Moira, to round off the presentation part of today.
Thank you very much. So my presentation centres around two things: our private investor index at Interactive Investor, which is basically data that we've been collecting around retail investor performance over the last couple of years. We have 400,000 retail investors on our platform, so we think we're a bit of an authority in this. So as you can see from the slide, over the past 2 years, it's the younger investors on our platform who've delivered the best outperformance. And the interesting thing that we pulled out from that is that they're leading the pack, we think, because they've got quite a high exposure to investment trusts, which I know will be music to a lot of your ears. I have to say, Interactive Investor, we don't have a huge number of younger investors, but it's interesting to see that trend on the platform. The bulk of our investors are in that 55 to 64 age group. They're the largest, not the bulk, they're the largest section, but they still have a healthy allocation to investment trusts as well. If you move on to the next slide, I can show those age band comparisons in more detail. You can see that over the past year, this is with the data over the past year, again, the younger investors have been ahead in terms of performance, and again, they have a higher allocation to investment trusts, which you can see in the red band in the table at the bottom right. And then if we move on to the next slide, I just wanted to bust a myth a bit here, because we can compare male versus female investment returns on our platform. We have more than 120,000 female investors on the platform, which is bigger than some other platforms in their entirety. So we think this is good data. There isn't that much difference between male and female investment performance. Where we do see differences, that women have slightly more investment trust exposure, they had slightly more UK equity exposure, and they had less North American exposure. But overall, you know, women who invest seem to be doing it fairly confidently on our platform, which is music to my ears. And my final slide today is, as Elisabeth mentioned earlier, we've been doing a lot of work at Interactive Investor in shareholder engagement. So we have written out to all of our customers, telling them of their rights to vote. We have done a huge amount of content on the platform, educational content, explaining key voting issues, explaining key votes that are coming up. And very, very importantly, as of the 1st of November last year, we switched everybody on our platform onto voting. So prior to that, people had to select to vote within their options on the platform. And from November, everybody was automatically switched on to voting, which is a free service that we offer. And that means unless they actively opt out of that, they are getting messages to their secure messages about forthcoming voting opportunities relating to their investments. And we feel that's very powerful. And at the time, we did a huge amount of PR around this. In fact, we've been doing a PR campaign all year around the importance of voting. We've had support from major industry players, Aviva, the chair, BP, the chair of BP. And we obviously got a lot of support from investment trust chairs as well. And we are seeing this nudging things up. So the number of shareholder votes that we actually processed on the platform was up in 2021 versus 2020 by quite a large amount. And we want to see that continue into 2022 and beyond.
Many thanks, Moira. That's great. Okay, well, let's start looking at some of the questions that have been coming through. So the first one we've got, not attributed to anyone, but someone has asked, to what extent has the growth of alternatives been driven by lack of performance of bond markets as a traditional hedge in portfolios? Who'd like to start with that one? What about you, Ewan?
Yeah, happy to give my point of view, and sure Andrew have a view from his portfolio as well. But definitely that's a key driver: the low interest rate environment, the lack of opportunity in bonds, or the potential to lock in capital losses in those, has been a huge driver of demand. Continues to be at these interest rate levels, and I think we've seen that over the last decade. Expect that to continue. I think there's the big test now is how these assets can perform in a slightly higher interest rate environment or inflation environment. And I think quite a few of the asset classes are actually well set up for that, with some implicit or explicit interest rate or inflation linkage. So I think that does give scope for some of these assets to continue to perform in these high rate or interest rate or inflation environments. But that's very much going to be the area to watch in the coming years as well.
Okay, many thanks, Ewan. Simon, I wonder, you might have something to add to that point, but Max King also has asked, where does the growth in investment trusts come from? Is it wealth managers, multi-asset, other institutions, direct investors? Do you want perhaps to pick up on both of these points?
Well, certainly I can speak on behalf of wealth managers. Clearly, we are participating quite fully in the growth, in particular in the alternative investment areas. And yes, it's for the reasons that Ewan mentioned, but also it's really important to remember that private markets are actually growing and public markets have been shrinking. If you look at a number of measures in terms of the number of publicly listed companies, how long now it takes for companies to go public, there's lots of evidence to suggest that actually private markets are growing and public markets are shrinking. And as investors, of course, we have to adapt to that. So wealth managers are participating in the growth of investment companies, and I think that growth will be overwhelmingly concentrated in private market and alternative investment areas.
Okay, excellent. Elisabeth, I wonder if you might jump in on a question that we've had about the investment companies that have reduced their fees over what says here 2020. I guess 2021. From what to what? Do you want to perhaps expand a little bit on that point?
I'm afraid I don't have the data. I was just having a quick look to see if I could find it, but I can't. But I'm sure that I can get an answer for.
Okay, excellent. And we can maybe come back to our audience on that particular point. Now, some interesting questions, and I guess let's see if we can find one for Moira. Let's see if we've got one here. So Moira, one of the questions was in terms of interactive investor and voting. Is there anything that you particularly want to expand on that particular point in terms of how useful that's been? Do you see that as being an area that you will expand more on?
Yeah, I mean, we think people should be engaged with their investments, and that's a healthy way to be. I mean, we've heard on the ESG side, which I didn't touch on with our customers, but that is growing on our platform too. People are interested in making sure that their money is aligned to principles, etc., although it's still quite a low base. But shareholder voting, I mean, we've made it an important issue to us as a business. We've had a lot of positive feedback from the customer base with our educational content around that, flagging key votes, and we will continue to do more on that. We have focused on the major direct shareholdings, so the big UK companies, but I think we'll be doing more around investment trust voting this year as well.
Okay, that's excellent. Thank you. Andrew, a couple of points, in fact, quite a few points picking up on stewardship in particular. So if I can perhaps run some of these questions together. Julian Bartlett was asking, and made the point that he thought your point on stewardship is spot on. Measuring it is very difficult. Any ideas on how to make that work? And Paul Yates was asking, do you see a risk that some investment companies might lose their UN PRI status due to lack of rigor as measurement and accountability become stronger?
Okay, so I just think in terms of engagement, the first thing to do is to get yourself in a position where you can have conversations with shareholders. And you know, that's clearly the starting point. And you people probably will have heard me make this point before, but I think it's worth repeating. Very often boards take quite a passive approach to shareholder engagement, and I would summarize it by sort of saying they make themselves available to shareholders. I often hear chairmen say, well, you know, we make ourselves available. That's not really enough. I think you need to be much more proactive and actually say, you know, we actually want to talk to shareholders. Please, can we come and talk to you? Because if you kind of just sit back and say, well, you know, they know where we are, it kind of gives the impression that the only value in that conversation is the shareholder. Whereas in fact, I think boards get a lot of value out of talking to shareholders as well. And I'm sorry to put Numis on the spot here, but you know, if your broker cannot get you meetings with your key shareholders, then you need to change your broker. So I don't think it's a good enough excuse to say that our shareholders don't want to talk to us. I think it's up to boards to really start that conversation. And you can have conversations on all sorts of things: investment policy, costs, and ESG. Because one of the interesting things about the UNPRI is actually that one of the main priorities for stewardship and engagement with companies is actually on ESG matters. So the UNPRI says to us, please engage with your companies, but please prioritize, when you do engage with them, have conversations with them, please prioritize ESG considerations. And there's a whole wealth of conversations you can have there with shareholders around that. So start the dialogue, get in a room with your shareholders, and I think you take it from there.
Excellent. Now we've got a general one. Victoria Rock was asking how the panel see rising inflation impacting the need to produce higher income for investors. Elisabeth, can I ask you to kick off on that one, please?
Well, I mentioned that, of course, in my presentation, and I think, you know, of course, it depends what the promises that you've made to shareholders, first of all. But if, as as a board, you have said that you will try to keep your dividend growth in line with inflation, then I hope that boards will be able to do that. And often companies have access either to their revenue reserves, which they can use when their portfolio isn't producing the dividends to pay out that from dividend income, or indeed there's a flexibility to use capital to do that. So I think that for boards it's a very important consideration for many shareholders who are depending on those dividends for their income. So I think that's yes, and there are ways that can be managed.
Thanks, Elisabeth. Does anyone else want to come in on that point?
Yeah, I'm
No?
happy to come on that, and maybe a couple of others that have gone by. But yeah, as I mentioned, that lots of the structures have that inflation linkage or interest rate linkage, which is going to be key on that inflation side of things. And I think investors being a bit more flexible about how a return is generated in terms of income and capital is something that we're definitely seeing a trend for at the moment. So it's, I can also probably touch on a couple of the ones that have gone on fees. We have seen, well, sort of almost universally things heading down, not completely, but quite a range of changes. Number of funds putting tiered fees in when they're growing for the top end of things, but a few have removed tiers and just gone for a simple lower fee. A few performance fees coming out, a couple of those leading to higher base fees, and probably the outlier being Brevin Howard that had a bit of an ultimatum to the board and saw the fees go up, but that's actually incentivized the manager to take on more assets and grow the vehicle. And if I may just add on where demand's coming from, I think sort of universally that retail investor, but through different areas, particularly sort of defined contribution pension schemes, self-investing, we're seeing a lot of that money flow into multi-asset vehicles or into private wealth managers that then flows through sort of indirectly into investment companies. So seeing that trend either directly through a platform or also other indirect routes. But sorry, slightly answering a couple of your questions there, but hopefully that's useful.
No, that's really helpful, Ewan. Thank you. I wonder if I might sort of put another one out to everyone in general. It's a question from Mark Little. He's asking or saying liquidity is obviously an ever increasing reason put forward by the wealth managers as to why closed-end funds are increasingly being passed over for open-ended equivalents. What do you see as the future, the long-term future, for suboptimal smaller funds? So I suspect we might all have a view on that. Who wants to kick off on that one?
Well, I'll kick off. I think my views on this are well known. There needs to be much more consolidation in the industry. Interest needs to be much more aligned so that consolidation can happen. I know it is not easy, especially when funds are trading at a discount, but where there's a will, there's a way. And fortune favors the brave. So I would encourage all NEDs to be thinking imaginatively about how to create scalable, liquid vehicles in this sector.
Thanks, Andrew. Moira, I wonder if there's a perspective that you would like to bring into that from the retail investor angle.
Well, I think, we always see certain products that are perennially popular across the platform among all age groups, really invest. There'll be a sort of a small group of investors on our platform who are looking for the niche products, but I mean the majority of investors are looking to the really mainstream and looking for things that will help diversify them, etc. I mean, we run 2 rated lists. I think we just announced today that we're going to hand over the daycare to Morningstar, but those rated lists, we've seen again some of the more niche ones on the lists are not getting as much attention as the more popular household name kind of investments.
And Elisabeth and Ewan, either of you want to come in on that one?
Yeah, I'm happy to. I think agree with Andrew and the continued drive for consolidation, but we have seen a shift in the last couple of years where historically I think that the obvious solution used to be, okay, we're struggling a little bit, what should we do? We'll review, we'll appoint a new manager either internally or get a new management group in. That'll reinvigorate things, and sort of job solved or problem solved, or that gives us a few more years and see where we go. But that as Andrew mentioned, the liquidity and providing a wholesale solution to making a marketable product, I think we're seeing a lot more action in that way of things like the Murray income perpetual income growth merger. So looking at that scale as an issue. There is a place for a small trust where they're very differentiated, but I think boards are getting more active in terms of looking for those consolidation plays as well, and I think that needs to continue.
Thanks, Ewan. And Elisabeth, do you want to quickly come in on that?
Yes, I'd agree with much of what is said there, particularly in crowded sectors. I think there will continue to be room for consolidation, and it's great to see that boards in the last year have really been working hard on that, and I'm sure that will continue. But equally, with my India Capital Growth hat on, I think there is a role for small specialist trusts, focusing on particular areas, and there's no doubt that there is demand for those. And so I think it's going to continue to be a broad sector, and we want people to produce new ideas. We want new trusts to come to market investing in new things, and they're not always going to start off as large trusts. So there has to be scope for that to happen.
Absolutely. Now, I'm just conscious of time, but I think to round things off, I'm going to ask each of our speakers just to, I guess, give us a bit of a soundbite, leave us with your key thought for the year ahead for investment companies. So let's go in order of the presentation. So Ewan first, please.
Well, yeah, the investment companies world can be seen, some commentators say it's a sort of sleepy backwater of the investment companies world, but I think it has and will continue to prove itself as a great breeding ground for innovation and growth and new strategies. So I think that leaves us in a very good space.
Excellent. Andrew? Sorry, Elisabeth next. Sorry, I'm getting confused by order. Sorry, Elisabeth.
But I think that shareholder engagement will continue to be the order of the day, and whether it is engaging with smaller retail shareholders or boards engaging with their more institutional / private wealth manager holders, it's absolutely vital that we go on doing that to the fullest extent possible, and to take on board the views that are given by those shareholders to us.
Thanks, Elisabeth. Andrew?
I'm going to agree with Elisabeth, and just to build on what she said very briefly, there's some of the comments in the chat about asking us how we can do that effectively, what best practices look like, etc. Let's have that conversation. It's a new area to a lot of us. I mean, we are stewardship and collaboration is new to us, and we're learning as well. So let's work together on it. And see what we can deliver for our respective clients.
Thank you, Andrew. And Moira?
So shareholder engagement, I've mentioned, we're seeing an increase, but we're not seeing an increase in shareholder engagement from those younger investors. And I think the whole industry has a real challenge in how you engage with younger investors in particular. I think we as a platform have a challenge there, and we've had a focus on video and podcasts, which seems to be working for us so far, but the world of social media needs cracking too.
Thank you very much. And thank you to all our speakers, clearly, for very informative and interesting sessions. So thank you. And of course, many thanks to you, our audience, for attending. We hope you found it useful and look forward to welcoming you to the next one. If you do have any feedback or indeed ideas or topics that you'd like to hear more about, please do let us know. And we would very much like to sort of pick up the pace on discussing some of these interesting topics going forward. So thank you again for joining us, and enjoy the rest of your day. Many thanks. Bye-bye.